Hi everyone, and welcome to the next episode of the HeelanHub Podcast, the show for small business owners. I'm Dan Heelan. On today's show, it is just me talking to you today about employment allowance. So whether you're a sole trader, partnership, limited company, there is something here potentially for you. However, if you're a sole trader, I would probably say if you're on your own and you don't have a team, it's not right for you right now, but it's worth listening just so that you can hear about what happens if I become a limited company, because even as a director, there may be some things there that's going to benefit you. Or if I did employ a team, how's it going to affect me? How's it going to be good for me? And that's definitely going to be a good thing if you're going to take on a team. So then, let's get on with it. So then in this podcast, I just wanted to explain the basics of employment allowance. Now, as the name suggests, it is an allowance that's really there for employers. So quite often, if you hear me suddenly refer to it as employer's allowance, it's a slip of a tongue, something I've been doing for years, but ultimately the true name is employment allowance. But it's for employers. And I think for me, it's one of the most pro-growth, pro-business allowances that's there, if not really the only one in recent times. It was introduced many years ago, and I thought it was a cool thing. Now, the way it works is that when you employ somebody, let's say you pay them $30K a year, it isn't costing you as the business owner and the business $30K. It's costing you $30K, plus you're likely to have to enroll them into a pension scheme, so there's another 3%. And on top of that, you had to pay this employer's national insurance bill. Now, that employer's national insurance bill started when you got over, say, about £758 a month. Once you got over there, you had to start paying it. Now, what happened is, if we cast our mind back to around the back end of 2024 in this £22 million black hole budget, is that they said, yeah, we're going to change all of that. So at the minute, you paid £758, no employer's national insurance for that person's wages that month, and then you paid 13.8% on everything above there. What then happened was they said, you know what, 13.8 is not enough, so we're going to make it 15%. Now, a bit of history on this. I don't know if you cast your mind back to many years ago during a certain pandemic, but what happened was they were mucking around with the national insurance. Then it was up and then it was down and all the rest of it. But they've returned to that viewpoint and thought, okay, we're going to charge more employers' national insurance. Says, let's make businesses pay. So they've increased that from 13.8 to 15. So you think, okay, maybe that's not too bad. It is, but let's just say you think just in a pure percentage terms, it's not that bad. But the double whammy here is they lowered the limit from £758 a month down to a mere $417. So you're only paying it, basically it's $5K a year. First $5K a year is employer's national insurance free, and then you're paying 15% on everything over there. And that is a really big deal. It really does add to the cost of employment. So that's why this allowance is good. Now, the allowance was only $5,000 a year itself. So I know that's a bit confusing because we're still talking about $5,000. $5,000 now is the new point, the new threshold where you start paying it. And the old allowance, the old employment allowance was £5,000 a year, and you used to be able to take that and reduce your bill, your total bill for the year by £5,000, your employer's national insurance bill. And that was awesome. What they did this year, which is good, is they took the $5K and they more than doubled it. So the allowance now is £10,500. If you get this wrong, you could be losing up to $10,500 for your business. So it really is important to make sure, because every year as a business, so accountancy business service provider, we have got payroll, bookkeeping, all that kind of stuff. Payroll's a massive part of our business. And every year we help at least, a handful of employers go and claim money back. Because if you haven't claimed this employment allowance, you can do it if you qualified, and we'll talk about that. You can go back up to 4 years and see, and you can get it back. And if you've overpaid, you'll get the money back. So it isn't all doom and gloom. If you listen to this and you think, oh my God, I've really missed out, I'm devastated, don't be. It's absolutely fixable. So let's talk about then, that's how the allowance works. So bit of a recap, I suppose, on the basics of how that works is in principle, we know up to £10,500 a year in the 25-26 tax year as we're recording this, you're going to be able to reduce that employer's NI bill. Now, the way it practically works is, let's say month 1, April 25, you've got a tax bill, and buried in that tax bill. So if you remember how this works as an employer, you've got your one employer, let's just say you got one employee at $30K and your wages as the director. Now, the chances are the majority of that employment bill, tax bill that you've got to pay over as the revenue is mainly their tax and their national insurance you've deducted from the money before you give them the net pay. But bundled in with there is going to be this employer's national insurance bill. Now, let's just say, for argument's sake, I've not got any maths in front of me, let's just say it's £1,000. So £1,000 of employer's national insurance, just to keep it simple. What you do is, if you qualify, you knock that £1,000 off your bill. So you handed over £1,000 less than you would have to the revenue, and then you bring forward $9,500 into May. May comes around, nothing's changed. Let's say your employer's NI, is £1,000 again. then you just knock that off. Don't pay the £1,000 to the revenue. Now you've got £8,500 to bring forward into the next month, and so on and so on. So if you're a large employer or a larger employer, you might actually eat all of your allowance in the April or the April, May, June or something like that. So, but either way, it's saving you £10,500. So for some bigger employers, so like us, we employ about 40 people, we'll eat it up very, very quickly, but it's a cash flow benefit because it gets around to April and it's like, woohoo, employment allowance is reset, let's go. And we get a bit of a cash flow advantage of not having to pay it in those months. So it's quite an exciting time for employers. But so that sounds good. You might think, okay, I get that. It's going to save me quite a lot of money. And how it pans out, I think we've done other podcasts on this, is that the changes at the back end of 24, in some instances, this increase in employment allowance is actually going to save you overall some employment costs. But it is a rare scenario. I think if you've got a lot of people who are, and you've got a lot of bands, and I won't go into it in this podcast, I know I've done a lot of talk about this over the last 6 months, it's going to increase the bands, it's going to increase the costs, and it is a lot more expensive from April. But we have seen some employers where you might have like 4 or 5 people on 30 to 40K, and it's panned out that this is actually better for you. It just depends where you are and what you pay people. So do that maths. So that's again, go back and listen to the podcasts and you'll find out me talking lots and lots about that. But it will help reduce it. So, and now you might be thinking then, okay, well, what have I got to do to qualify? And really, there are more criteria, like anything with tax. Where I sit recording this, there's a load of books behind me that have got 22,000 odd pages worth of tax. But this one, there's always caveats and things you have to bear in mind. But there's, I suppose, 2 different scenarios that are really key for most small businesses. Caveat, as always, go check out your individual circumstances. But if you're a business and you do less than 50% of your work to public bodies, so you're not like an NHS provider or a local council or anything like that, and you're in business, then actually you probably qualify. It's quite an easy qualification, but you're disqualified if basically you're a sole director. If there's only one director, you're basically not going to be able to claim. It's a little bit more nuanced than that, but if you think about it, for most people, if you're just a one-person limited company and you're thinking, cool, I can claim this for myself, you can't. The reason being is that when it was launched many years ago, wasn't even that many years ago thinking about it, but when it was launched, everybody, all the accountants and the payroll providers and all the geeks, when it worked out quite easily that if we paid more salary to the director, there was a certain break point where this worked. You'd get a bigger corporation tax deduction by claiming the allowance. So, and that wasn't how they intended it, presumably. So they stopped that loophole and said, no, we don't want people doing this. So if you're a single director, you're not going to be able to claim it. But it doesn't stop 2 directors who, if they're paid over the £417, and it also doesn't stop director plus, let's say, paying their significant other to do some work in the business for admin support or marketing or whatever you want to do, as long as it's legitimate work. And if you get those over that value, so you're both, in theory, paying that employer's national insurance, this allowance is going to cover it and you can save some considerable tax by using it. So just have a play with some numbers, or if you're working with an accountant, I'm sure they would work this out for you. But if you're not sure, just ask them. Accountants are rubbish at telling people what they actually do. So go and speak to them and I'm sure they can just keep you informed. In fact, I had a client asked me the other day, did we claim this? I was like, did we claim it? Do you not read anything we send or any of the podcasts or any of the usual talk to your accountant? And they're like, no, I just didn't really think about it. But yeah, of course. Most accountants by default will end up claiming it for you. But just if you're really worried, just do go and ask and just put your mind at rest, because in all honesty, there are accountants that do miss these things, so it's worth checking. But if you're doing it yourself, I think that's the majority of times we see it, is you're a new business, you might not have done payroll. Maybe you're running payroll on something like Xero, which some owners do. I think that's the most common one we see. The revenue do something called Basic Tools, which is like a free tool, and that can run all right. I think they're discontinuing that soon though, just randomly. But anyway, so the Basic Tools is a free piece of software. I think it should be done under the Trade Descriptions Act for being called basic though, because I don't think it is that basic unless you know what you're doing. I recently recorded a YouTube video showing a demo of how you might claim employment allowance. So if you're interested in seeing some more of this, if you go to our main channel at Heelan Associates, you'll see there's I think it's entitled Make Sure You're Not Missing Out on $10,500 a year or something like that. And there's a few screenshots of the basic tools and other ways of claiming it as we're about to mention. But where we see it the most is somebody who's either using basic tools or they're using, say, Xero payroll, which is a cool payroll thing, but they just don't know what they're doing. They don't know what that means. They don't know how to claim it. Because all you've actually got to do to claim it, it's done inside of your payroll software. There's a box that you tick. So you might know if you do your payroll right now, you'll submit something known as a real-time information, an RTI report on or before the payday each month. You send it to the revenue. It's all electronic. Fire it off and forget. If you don't, they fine you, of course. Now, that's done. But if you want to claim employment allowance for the tax year, all you've got to do is submit another version of one of those RTI reports. They call it an EPS, an Employment Payment Summary. And it tells them lots of other things that you might have going on in the business, but for most owners, you don't use it very frequently. But all you need to do is send it once during that tax year, and it should flag them. Now, I say should because one of the things I would massively encourage you to do after you do this is wait a little bit of time. So submit it, wait to probably around the 22nd of the following month. There's reasons why, but just say 22nd of the month to be sure. Go in and have a look. And what should happen is if you can log onto your business tax account, you should see it. If you had employers' national insurance to pay, you should see employers' national insurance and then the employment allowance shown there separately. So just check it's working. Once you've seen it working, it should just work. It should be fine. But I say should because the revenues PAYE section of their back-end system is by far the worst section. It's been weirdly one of the longer sections and we couldn't do without it. But when there's a problem with this data, there could be a problem. We've got a client I can think of that's getting chased for £24,000 that they don't owe because the system's wrong. Nobody can get it fixed. It's the revenue's fault. They know it is, and their advice is complain, and we'll see what we can do. Well, we've been complaining, and we still can't get it done. So I don't want to scaremonger you into worrying about it, but you speak to any accountant who does payroll, and they'll tell you all these horror stories. So just make sure, do like small and often with anything you do with payroll like this. If you're going to make a change, do it small, wait, see how it's reflected, and have a look. And that's a big takeaway from this for sure. If you're doing anything to do your own payroll, don't change things en masse. Go small steps, see how it's happened. If you're thinking, I haven't got that in my business tax account, or I haven't even got a business tax account, make that an action point from this podcast. Go get yourself a business tax account and make sure you add the tax that's the payroll tax so you can see it. And once that's going, you should be fine. Now, if during the year you think, I'm now not employing anybody and that's it, you can do the reverse. You can untick the box and submit the report and it will unflag it. Be very careful of doing that because what I would say to you is, for all the reasons I said about tax being, complicated and you should check eligibility, go to the revenue, read their manuals if you've not got an accountant and just check. The guidance on the website is pretty straightforward in this area, actually. It does tell you. However, it leads you to some guidance notes that might make you think, I've got to repay all this employment allowance now I've got rid of somebody. It's not true. The way it works is if you claim it and you were eligible at any point during the tax year, you're still eligible. There's just a clash of guidance, but you can't carry it on into the next tax year. So if you just need to make sure that flag is off, you've submitted an unticked thing when you get into the new tax year. So just bear that in mind, keep an eye on that. But yeah, don't get confused. If you've already claimed it because you were entitled to it and then if something changed, it's fine for this tax year. You've just got to make sure it's not into the next tax year. You won't have to repay it back. So just make sure that flag, as it's known, is on or off. You've submitted the report to turn it on and you've submitted the report to turn it off. And once you get going, you're in a really good place and it should be fine. Now, and as we said, you can go back up to 4 years. And that's how you would do it. You'd actually load up. Sometimes it's actually easiest to get the PAYE basic tools. I know I was taking the mick out of them to submit those if you haven't got, because it can be difficult on like a Xero or a QuickBooks or any of these things to kind of sometimes go back and submit those things if you haven't already done those tax years. But I would say because of the values you're talking about, so it's 10.5 grand this year, but it was 5 grand and 4 grand the years before. So it's still a substantial amount of money. I would go and seek professional support if you need it to go and submit these. If you've got a back claim, because you really want to make sure that they're doing it and it is active on the right year, and then you can write and get your refund. And bearing in mind the values we're talking, I think it's definitely worth the investment of getting somebody else to do this because of all the reasons I've just said. So have a look at that. So we've talked about the reasons why you might qualify in basic sense, but do go and check those out. We've talked about how you claim it. And how you submit your employment payment summary if you need to. Now, one of the things I do want to mention is that one thing that is a big red flag that catches people out is if you've got multiple companies, and this is very complicated to a degree, but let's just take the easiest scenario. You've got a limited company with employees over here. You decide to boot up a brand new limited company and you have a new team here. You can only claim employment allowance on one of the businesses. So when you're doing your numbers to work out if this is going to work, bear that in mind. Only one of them is going to be able to claim. And you might instantly be thinking, oh no, well, what happens then if I've got a business over here by myself and then I start this other thing up with somebody else? How's that work? that is almost an entire show on its own, telling you about what you've got to consider. But it's all about control, and that's all kind of defined in law and everything else. But just know that you're going to need to look into that to make sure you can qualify. And in some cases, it's fine. Like if you've got one on your own and you've got one 50-50 with somebody else, you might be completely fine, but go and check. But it's the situation where you're sort of the majority owner, but it's not as simple as that. There are other factors. So make sure that you check those are okay. And of course, make sure that your business tax account is showing you what's happening in the back end, so you can make sure. And as we said, from a recap point of view, if you do need to stop claiming, make sure you do that, but just don't get baited by the guidance, because it is a bit, what's the word? Of a clash, I suppose. So that is basically it. And as we said, I think the main thing is you've either got a team and it's reducing the costs. Everyone's winning there, because the costs are pretty substantial these days of employing anybody, factoring in holiday, pensions, employment allowance, and all the other stuff and the compliance that goes with it. But anyway, it's going to be expensive, but it's really, really going to help relieve those costs. But if you're just a small company just starting out, and there's a couple of you as a director, and maybe you've got a significant other or a family friend or somebody that's working in the business, consider their salary levels, because you might then be able to turn this employment allowance on, and it saves a lot. So I remember a scenario last year. Well, I looked at several of these for a client last year, and it worked out well. They wanted to employ one of their kids who was probably 17, 18, and we worked out that actually adding them on, by the time you'd put in employment allowance and everything like this, their salary was considerably inexpensive because of the offset of employment allowance. So do check it out, but just make sure you qualify, because that's always a stinger if you claim it and then get it wrong. So and have a look at that. And that's it. So hopefully you've enjoyed this podcast. I've tried to keep it short and sweet. Ish, looking at the time, short and sweet-ish. Do remember that we're recording these and throwing them up on an alternative YouTube channel. So we've got at Heelan Associates, which contains just, near, I think 300 odd videos of different tax subjects. And we're really trying to make an effort there. So if you haven't checked that out already, please do go subscribe, like, and all that kind of stuff that YouTubers say. But there's a side channel just for the podcast. If you do just want to just watch me ramble at the camera or at the laptop, instead, that's good. But the reason we did it is because the comment section makes it far easier to interact with you. So go in there, comment, ask me questions. I'll do as much generic advice as I can give you in there, or if not, I'll signpost you to where you might get some more support. But it's really cool to be able to interact in there. I know many of you have heard me talk about this before, but it's odd coming in late at night or early in the morning when I record these things, which why I was looking knackered on camera, and talk at a brick wall and then not have the interaction we have on some of the other channels. But of course, if you are interested in more of these topics, make sure to subscribe via whatever app you're getting it from. And if you do get 2 minutes, a couple of star reviews. I don't mean that, 5-star review. And if you've got a couple of moments, a nice comment or something would be really cool, just to help our visibility. And of course, go subscribe to the YouTube channels. If you want to interact with us on the social medias, we're on all of them. So LinkedIn, Twitter, Facebook. We do a lot on Instagram, DMs actually, LinkedIn, of course, all those different channels. We're just not on probably Snapchat. I don't think we're cool enough for that. But the majority of channels are on there. So go interact, follow us on there. Always happy to talk on there and see how we can help. And of course, if you do want these things direct to your inbox, you can sign up to our newsletter. So you can do that, our email newsletter at heelanassociates.co.uk. Scroll around long enough and you'll get a pop-up. You can stick your email in there, and that data is only for us. We never partial data to anybody else. We just want you to get the insight that you're coming to see. So that's a really great way of keeping up with everything. It'll have news, articles, all the rest of it. So go from there, latest videos, whatever else we think is useful. That's it. Have a profitable and tax efficient week, and I'll see you in the next one.